Today we'll understand risk-neutral interest rate volatility and how it affects the term structure of interest rates. First, let's understand the basic idea of risk-neutral interest rate volatility. In a risk-neutral framework, investors price bonds using the probabilities of future interest rates instead of personal risk preferences. To represent how interest rates might move in the future, we use something called an interest rate tree. In this tree, the rate can move either up or down in each period. Typically, we assume equal probabilities, meaning a 0.5 probability of an upward move and a 0.5 probability of a downward move. When interest rate volatility is higher, it means future interest rates can move more widely. This uncertainty affects both bond prices and the shape of the yield curve. Next, let's calculate the expected future interest rate 1 year ahead. Suppose the current 1-year interest rate is 7%. After 1 year, the interest rate could increase to 9% with probability 0.5, or decrease to 5% with probability 0.5. The expected interest rate is 7%. Notice that the expected rate is equal to the current rate. This confirms that the tree is risk neutral. Now we can price a 1-year zero coupon bond that pays $1 at maturity. The price is 1 divided by 1 plus 0.07, which equals 0.9346. Now let's look at expected interest rates 2 years ahead. In the second year, the rate can again move up or down from each node. This creates 3 possible outcomes after 2 years: 11% at the upper node, 7% at the middle node, and 3% at the lower node. The joint probabilities are 0.25 for the upper path, 0.50 for the middle path, and 0.25 for the lower path. We calculate the expected rate as 7%. So even though rates can move up or down, the expected value remains consistent with the risk-neutral assumption. Next, let's price a 2-year zero coupon bond using the tree. A 2-year zero coupon bond pays $1 at maturity. First, we calculate the bond price at the 1-year nodes. At the upper node, where the rate is 9%, the price is 1 divided by 1 plus 0.09, which equals 0.9174. At the lower node, where the rate is 5%, the price is 1 divided by 1 plus 0.05, which equals 0.9524. Now we move backward to calculate the bond price today. The price today is 0.8737. Finally, we calculate the implied 2-year spot rate. The spot rate R of 2 satisfies the equation 0.8737 equals 1 divided by 1 plus R2 squared, which is approximately 6.93%. The key insight here is the effect of interest rate volatility. When future rates are uncertain, the interest rate tree includes both high and low possibilities. Because bond prices increase more when rates fall than they decrease when rates rise, volatility tends to push bond prices upward. Higher bond prices mean lower implied yields, which means that greater interest rate volatility can actually reduce long-term spot rates in the term structure.